All right, to demonstrate how to calculate internal rate of return and what it is, and also compare it to cash on cash, I built this quick little Excel spreadsheet, and let's just run a scenario. Let's say that you buy a property for $1 million, and that every year that property pays you $100,000. So net expenses, you're going to make $100,000 a year every one of these years. And then let's say at the end of year 5, you're going to sell it for a profit. And so you're not just going to make that $100,000, you're going to sell it for another $1.25 million. So at the end of year 5, you're going to make $1,350,000. Now, to calculate the annual internal rate of return, you can use the IRR function, and you can see returns the internal rate of return of a series of cash flows. So all you have to do is throw up the parentheses there, drag from year 1 to year time point 0 to year 5, and then you'll see this won't work. It gives us an error, and the reason there's an error there is because at year 0, when you buy it for $1 million cash, this number right here needs to be a negative because money is leaving you at that point. And so it's a negative number. That $1 million is leaving your pocket, and the rest of these cash flows are cash coming to you that you can put in your pocket, so they're positive. And you can see when we make that one adjustment, your annual internal rate of return for this series of cash flows, buy a building for $1 million, make for you $100,000 a year, and then sell it at the end of year 5 for $1.25 million. This deal right here would give you an annual internal rate of return of 13.8%. So that's pretty good, not too bad. Now to compare it to cash on cash in year 1, what cash on cash is it is how much money you get back for how much money you have in. And so if you want to calculate this on year 1, all we have to do is say this cash flow at year 1 divided by how much money you have in the deal. And in this case, they both need to be positive. And so let's format this a little differently. And you can see the cash on cash from year 1 on this deal is 10%. The annual internal rate of return is 13.8%. And that is because we have this large hit at the end of year 5. And so what this 13.8% is telling you is that for 5 years you have $1 million of your cash in this deal, and on average it's making you 13.8% every year that your money is in this deal, in this case for 5 years. Now this is an unleveraged example. Let's say we have financing in the deal, and so in this case we're going to say we're going to leverage it 0.8%, so 80% loan to value, so 0.8 times the loan amount. That's going to give us a negative $800,000. Say the interest rate is 6%, and let's say the term is 20, pretty standard terms as of today. To figure out the payment here, we use the payment function. This is a little tricky, but you can understand it pretty quick. We want to convert to get the payment to monthly. So you can see this first is the rate. So we want to take the rate, we just click on here, but we want it in terms of monthly rates. We're going to divide by 12. The next we're going to go to is the number of periods. That's the term, but again we're going monthly here, so we're going to multiply that by 12. Then the present value is the present value of the note or the mortgage, which is $800,000. It's a negative. And then the future value is 0, because at the end of this term it will fully be paid off. Hit enter, and that gives us a payment of $5,731.45. To get the annual debt service, we just take this and multiply it by 12, and we can see what our annual debt service is. Now we need an amortization table to do that. That's for another video maybe. But the ending balance of this loan at the end of year 5, because we're going to project a sale at the end of year 5, is $685,988.91. So we're going to plug that in. Now all we have to do to figure out our leveraged annual internal rate of return and compare it to the cash on cash in a leverage deal is we're going to take what we have over here, and then we are going to subtract the money we're going to get from the bank. So that ought to give us $200,000. In this case, if you think about it, over here on unleveraged, you put $1 million of your own cash in. Over here with leverage, you're going to use $800,000 of the bank's money, and you're going to put $200,000 of your own cash. Now, on these, I'm going to take $100,000 is what we get back, except we have to subtract from that the annual debt service that we're going to be paying the bank on the $800,000 that we borrowed. And so what we're going to get to keep is $31,000 and some change. And we're just going to do this a few different times. And then on the sale, the first thing we're going to project is year 5. We're going to make $100,000 in rents. And we're still going to be paying the debt service. So we're going to subtract the debt service. Then we're going to add the sale price, which was $1.25 million. And then we're going to subtract what we owe on the mortgage at the ending balance of the mortgage at year 5. And that will give us $595,231 and some change. And then we can calculate our annual internal rate of return. If you remember, it's just IRR, parentheses, swipe down on these cash flows, close the parentheses, and that gives us 34.18. And to get our cash on cash for year 1, it's pretty simple. We're going to take year 1 cash flows, and we're going to divide it by the negative 200,000, because that will give you a positive number, and that's the amount of money that you have in the deal. And that is, we format that a little different. That's 15.61%. So here's what we can tell. One is the internal rate of return is the amount of benefit or the work or the return on your investment that your money gets over the time that your money is in the deal, in this case 5 years. It's different from cash on cash, which takes a snapshot of one point in time. It's generally an annual number, and it is a year's cash flow divided by the amount of money that you have in a deal. But this is an example of what internal rate of return actually is and how you calculate it using Excel.